We expect three waves of selling typically in this instance, and there were your two strikes. So we've had one and we've had two. These might be a tiny bit small to be truly reflected, or they're sufficient. It's a bit difficult to tell. And within that, when I draw how we are working out, we are potentially still in a bit of a rising wedge. We might be a bit of breaking out of that, but we might be in a bit of a rising wedge over here. So sometimes it's possible that you can pull back. I would still bias to the bull scenario, and I think you've got a clean run, but not too fast, not as in the melt-up period over here. Ups, down legs, steady movement. I think we're going to get beyond 100 in this upward move. I don't necessarily think that transpires into a whole new high, but the fundamentals will dictate it, and our macro, so we have a next level target of 333, and then we have a final level that we will sell off our silver holdings at single-digit gold-silver ratio.
The market is in a phase that confuses many, where strong momentum is followed by sharp consolidation and mixed sentiment. Gold and silver prices reflect this tension, with volatility hiding a broader, possibly intact trend. Francishunt, a technical analyst known for pattern-based market interpretation, explained that these pullbacks are not unusual within a larger bullish cycle. Instead, they often represent a reset phase in which weak hands exit and stronger positioning takes hold. He points to the importance of understanding crowd psychology, where excessive optimism at highs is typically followed by disbelief during corrections. In this environment, deeper retracements can occur even while the longer-term trajectory remains upward. The implication is that current price behavior may not signal weakness, but rather a necessary phase before continuation, especially if key structural levels continue to hold. Now we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I am keeping an open mind to the fact that there might be a retrace. And one of the reasons is we expect three waves of selling typically in this instance, and there were your two strikes. So we've had one and we've had two. These might be a tiny bit small to be truly reflected, or they're sufficient. It's a bit difficult to tell. And within that, when I draw how we are working out, we are potentially still in a bit of a rising wedge. We might be a bit of breaking out of that, but we might be in a bit of a rising wedge over here. So sometimes it's possible that you can pull back. I would still bias to the bull scenario, and I think you've got a clean run, but not too fast, not as in the melt-up period over here. Ups, down legs, steady movement. I think we're going to get beyond 100 in this upward move. I don't necessarily think that transpires into a whole new high. Can you get that sell-off that you're asking about? It could happen, but I don't think it's going to be brutal because we've dissipated. The shock and the volatility has been squeezed out of silver far better than it has out of gold, because you've got a constriction pattern that squeezed the volatility out and it's sort of walked out. But there is still a possibility that you can get one more sell-off. I don't think it's base case, but it's possible. And once that's happened, I still expect you to walk out into the 100 and the previous high. I expect you'll have a localized top, just to preempt any questions about where to next. I'm not sure we're going to easily just go straight into new highs. So this whole structure might require more winding up. There's a lot of things that could cause a bit of deflation and a bit of fear and a bit of hitting the sell. Not that it's silver, I feel, should be, but in due course could see it pull back from these 100s one more time, and then we create a larger continuation pattern to make the new high. So don't assume just because we get above 100, it's automatically just going to walk through to new highs. It can do that. Don't assume it. And there is still a possibility we can dip because we're in a bit of a channel that we've walked out of so far. I can't say anything too much more than that, apart from saying the possibility exists for that downside move. The patterns are different, so the criteria needed for silver to break out was far less because of the constriction. So we might be looking at something that is just mild bullish recovery, but because of the pattern, it's a walkout break, whilst you still need gold. Gold is the king of precious metals. We can't ever ignore that fact. And it's still in range in its pattern and has got to walk its way out to the high side there for a bit longer. So that's why I don't think you're going to get the extremity of fireworks that you came into this pattern structure with for a while, because you've not got gold making new highs also yet. That's going to take a bit longer. So I don't know if that part answers that. Gold's got a bit more to do before it's joined the party, and they'll run better together. And gold's just deep in range. Not many people getting unduly excited by gold because it's just steadily working its way back. The smart people are noticing, you and I are noticing as precious metal heads, but the market and the average Joes are not. So we're not going to get the headline grabbing moments just yet. I still think silver is one of the finest sweet spots in all the markets. Silver is the best market for me. We've just had the most unbelievable purple patch from September, the breakouts of September of last year, right the way through to the end of January of this year. And we were fortunate enough on XAG to have got out at around the 111. So we didn't ride the elevator back down. And even for those that at an investor level did, your lowest point was $61. And for us, the bull period started at 25.9. So you should be already well beyond 3 times at the lowest point. And of course, we're already back at 80 at the moment. We've traded 81. So as investors, people should recognize this. And I have continued, particularly during this period here, to add at an investment level aggressively, So I would suggest that's a good line of investment for people. For active traders, you have to be a tiny bit more selective, and that's why we are fascinating about whether there can be another pushback. This looks like, however, a good reversal, and you've triggered the falling wedge breakdown. There's a slight question of, have you had a deep enough dip as a return move, or have you had a deep enough of the third selling offs that, like we had the clear 2 there, they're always more subtle on the third impulse. And you can see you had a rejection on that candle. You then had quite a deep dip on that candle. You had an in-between low range candle on that day, and then you had another hammer dip. So there has been some sell-offs in that. The question is, did we let go of everything we needed to? And are the fundamentals of the market starting to come through as people are needing to find inventories for silver? And is that the driver behind the technical move up? I'm biasing bullish, and I am long silver at the moment. And short Brent, by the way. I think stagflation is the next stage generally for all of us. So even if the oils come off a bit in price, I don't think a perfect, tidy, pure peace is being secured. We tend not to do that. I mean, the Russian-Ukraine war is we've all got fatigue on that, even before getting Hormuz fatigue, but that is still technically alive and happening, and unfortunately probably lives are being lost and some structures are being damaged, military and not so military, but it's become quite low tempo and is not at the foreground. Now we have this new one. I feel Hormuz goes the same route, but you're left with the increased shipping rates, the increased insurance rates, and even with oil coming down by cost, you may not see the pass-through of that as meaningfully. And I think stagflation and our more extreme version, rolling into our more extreme version of hyper-stagflation, is 100% on the cards. And it's a precursor to enrichment of the billionaire classes, because the stagnation contracts and debases the debt that they've raised in building their mega corporations, but their corporations' share prices will hold or climb in nominal terms, hold in real terms for the debasement that goes on. So it's a billionaire class maximization economic policy, stagflation, whilst for everybody else, upper middle, working class, blue collar, however you want to describe them, the increase in living costs does disproportionate damage to their general wealth, and they become forced sellers of assets, which will see asset contraction. And of course, the debt debasement sees higher rates that we've continually called for, which is also very bad for financially engineered assets and bad for tech. So crypto will hurt, tech will hurt, and we think this comes in May. There's a famous saying, sell in May and come back in St. Leger's Day, which is in and around everyone returning, I think it's September. So the Northern Hemisphere summer is not actually a good season for risk assets generally. So if those rates go climbing, it won't all be straightforward necessarily for metals, which is why I'm suggesting we get back into the upper echelons and we may pause and wind up again a little more before breaking to new all-time highs. But the fundamentals will dictate it, and our macro, so we have a next level target of 333, and then we have a final level that we will sell off our silver holdings at single-digit gold-silver ratio.
Technically, the structure shows broad consolidation after a strong move. This pattern lets price test lower support zones, sometimes more than expected, before a new base forms. These moves often shake confidence just as attractive opportunities arise. The focus is on Fibonacci retracements and support levels. Silver could drop to lower levels before stabilizing, although this may seem opposite to recent bullish sentiment. Markets often act this way in transitions. Disbelief and negativity often signal opportunity. If price holds these levels and forms higher lows, the larger uptrend may continue. Let's get back to the interview.
So typically in the beginning of bull markets, before we pivot to the charts, you wait for gold to move first. And gold must move first, then silver follows, then starts to out-accelerate, and then you get this corrective period. And often many people would think that you would wait for gold to start the next stage when you have something of a meaningful time frame correctively. What's different about this is that silver set up a different kind of continuation pattern to gold. It also had its worst sell-off in the first stage of selling off, whilst in terms of gold, it had its second stage sell-off was worse. So I'm describing a lot. Let's show you because it's actually beautiful to see. I've got silver up here. Let's go and do the share screen. Let's just start with silver, and then I'll show you how they were different later, because it can get a bit complex when you're having two charts at once. So here's the silver, Elijah, and this is why we liked it. That's a falling wedge. We really like that for continuation because there's a squeeze component to it. Here's the falling wedge. It's capturing the highs, and it is called a capping descending grind line by our maximum theology and lexicon of language, I suppose. It is one element of a falling wedge. We also include a splitter, which actually aggregates the aggregate descent for the period since the blow-off high, which was 121. This is called the capping descending grind line because you get sold off at the key points across the top. It is descending of nature, and it's capping, it's across the top. And what we have had recently is you had that lovely little hammer. You had it leaning against that, and then we broke out of this. So you are in a period now where you are moving out of a falling wedge. And that's inherently very bullish, and that's a triggering event for us. There was even a gap in there, by the way, from the open to the close. You did go up a lot higher, and then you got a little bit pushed back. So you do have that return move. You can see you came down back to a low over there, and you've revisited it again there. But since yesterday was a fabulous day in terms of percentage, we're now seeing reassertion and a degree of momentum picking up in terms of all of that. So, yeah, this is very positive. Falling wedge, a breakout. Now, if I just bring gold into the equation and I put them, I'm going to split the screen so you can see them side by side. It does mean they shrink a little bit, but if I just put gold in here, and you will see that there was a slight difference to how they sold off. This is with the same broker. Let me clean that face out there and move it across. So we just see this corrective period. I'm going to try and broaden, get as much real estate as we can here. So what you had with gold was slightly different. The broadening structure goes like that. It's not a falling wedge. It's a broadening structure. That means you keep getting wider. A falling wedge has constriction in it, which is compression, which is also what gives you the move. It gives you the heads up for the break a lot sooner. Whilst this still has to be broken before gold is in a full break. So gold's got to toil its way across a much longer distance. And I want to highlight that you sold off there on gold, but this was a far more intense and bigger and deeper sell-off for silver. I'm just going to throw some numbers on that for you just so that it's not hearsay and visual effects. If I just grab that, the percentage downside, you would expect it to be higher for silver on a down leg, was 47%. You were almost half. Gold, however, and we often talk about it having a lower beta in the tricky times it's better to have, was 21%. It's a big difference in 47 and 21. However, what I would highlight is that gold almost had a deeper dip second time around. The second time it fell 24%. So the acceleration part 2 was higher on the sell-off. Silver had sold off 47% the first time, and in its second sell-off was at 36. So it was already reducing, dissipated. It's still a higher beta. It's still more than gold on the second leg, but it was already showing signs of reduction. This is why we have a broadening structure on gold, and we end up with a constrictional structure on silver. And this is why silver is given an earlier potential break signal, and why it's also been outperforming against gold recently. So it's a triggered pattern that was a compression pattern, while gold is still in range of a broadening pattern, both of which are continuation patterns for upside in due course. So even though gold is lagging, we're not bearish gold. We just think it's got to lumber its way across to the other side here. It might have some reaction once it's above the 5s, and then it breaks this capping descending grind line that is the top part of this broadening structure that we've drawn for you over there. So you can see one's a megaphone, one's a falling wedge. So silver is the dominant, is the better mover for now, and we're in a reflation, and that's quite non-standard, but I will say here's why I think it is that way. We are now deep in a bull market. The need for most people to realize it's a bull market is less there, although there's some burnt hands following the sell-off there. And as a result, silver is also more in short supply, I imagine. Getting the supply at these prices is far harder. So for some fundamental reasons, it's going to overperform generally for part of the reasons we have always understood that we've discussed many times before. Undersupply, overconsumed, inventory drawdown, etc., etc. Gold doesn't have that same degree of fundamentals that go with it. So that's a fairly comprehensive answer to your question. I hope I've encapsulated everything you were looking for.
The broader outlook ultimately hinges on how the price reacts at critical support zones and whether the market can transition from correction into accumulation. If the current structure unfolds as expected, the next phase could see a powerful expansion, driven not just by technical breakout patterns, but also by shifting sentiment. Markets rarely move straight up. Big rallies often follow doubt and frustration. If gold and silver hold their retracement levels and regain momentum, the bullish cycle could continue. Previous highs would likely be challenged with faster moves once resistance breaks. If key levels fail, the thesis is delayed but not invalidated. This would stretch consolidation and increase volatility. The focus should be on spotting when structure favors momentum, not on exact price targets. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.